the Mastery Mindset podcast channel. The Wealth Series. Master your mind and unleash your potential. Welcome to the Mastery Mindset podcast channel. Today, we're going to talk about the exciting world of investing in 2024. The investment landscape is constantly changing, and staying ahead of the game is crucial for working-age investors. In this episode, we'll explore some essential guidelines to help you navigate the investment world in 2024. We'll break down each point with practical examples and tips to ensure you make informed decisions. So, grab a coffee, sit back, and let's get started. 1. Understanding the economic landscape. As we delve into the concept of understanding the economic landscape for investing in 2024, it's essential to recognize that this year brings with it a set of economic dynamics that are truly distinct. To illustrate the significance of this understanding, let's consider a few critical factors that are currently shaping the financial markets. Imagine you're in the midst of making a decision to invest in stocks. This decision isn't isolated, it's influenced by several interconnected elements. One of these elements is the specter of rising inflation. Inflation is the increase in the prices of goods and services over time, and it's on the rise in 2024. This rise in inflation carries with it implications for the broader economy and, in particular, the stock market. How does inflation affect your stock investments? Well, it's not uncommon for central banks to respond to inflation by raising interest rates. This is a measure aimed at cooling down the economy and reducing inflationary pressures. However, it has a direct impact on stock prices. Higher interest rates can make borrowing more expensive for companies, resulting in increased costs for businesses. This, in turn, can put downward pressure on corporate profits, which is a crucial driver of stock prices. Now, let's pivot to another element in this economic landscape. Slowing economic growth. Economic growth is the engine that drives corporate profits and, consequently, stock performance. Slower economic growth can translate into reduced corporate earnings, which can have a profound impact on stock prices. So, if you're considering investing in stocks, it's vital to keep a close watch on economic growth trends. The pace of economic expansion directly influences the potential returns on your investments. And finally, let's not overlook the geopolitical tensions that are simmering on the global stage. For example, the ongoing conflict in Ukraine has far-reaching consequences, beyond just the political realm. It disrupts global supply chains and energy markets. In a world where interconnectedness is the norm, these disruptions can have ripple effects throughout various sectors of the economy. So, as an investor, what can you take away from this understanding of the economic landscape? It's clear that you're navigating a dynamic environment, and this environment is not only influenced by economic data and trends but also by global events. Keeping an eye on these economic trends and considering their potential impact on your investments is fundamental. In conclusion, to succeed in investing in 2024, it's not just about selecting stocks or assets. It's about comprehending the broader context in which your investments operate. This understanding is the bedrock of making informed decisions and securing your financial future in an ever-changing economic landscape. 2. Focusing on long-term goals. In the world of investments, especially in the stock market, it's crucial to understand that volatility and uncertainty can be the norm in the short term. Market fluctuations, driven by various factors like economic news, corporate earnings reports, and even geopolitical events, can make your investment journey feel like a rollercoaster ride. However, as a working-age investor, it's essential to adopt a strategic mindset that emphasizes the significance of long-term goals. This is a foundational principle that has stood the test of time and has been validated by history. Let's consider an example to illustrate this point. Imagine you're on a journey to save for retirement, a life goal that spans several decades. This journey, much like a marathon, requires perseverance, patience, and a focus on the finish line. Short-term market ups and downs should not deter you from your ultimate objective, which is securing your financial future for retirement. It's easy to get caught up in the daily or even yearly fluctuations of the stock market. News headlines can be sensational, and market sentiment can swing dramatically in response to various events. During these times, it's tempting to make impulsive decisions based on fear or greed. For instance, you might see the market drop significantly over a few weeks, and the temptation to sell your investments may arise. But it's crucial to remember that these short-term fluctuations are just part of the journey. History has shown us that, despite these short-term fluctuations, the stock market has generally trended upward over the long run. In fact, the stock market has historically delivered substantial returns over extended periods, and it has outpaced inflation. This means that investors who remained committed to their long-term goals, even during turbulent times, have been rewarded for their patience. By maintaining your focus on long-term objectives, like saving for retirement, you're less likely to be swayed by the emotional rollercoaster of the market. You'll be better equipped to withstand short-term market turbulence, and you'll be less prone to making rash decisions that could potentially harm your investment portfolio. In summary, the wisdom of focusing on long-term goals is not just a catchy phrase, it's a fundamental strategy for achieving financial success. It's about recognizing that investing is a journey, much like a marathon, where the finish line represents your long-term financial objectives. And just as marathon runners persevere through the twists and turns of the race, you, as an investor, should maintain your resolve and stay committed to your financial goals despite the short-term market rollercoaster. Remember, history has consistently shown that the market rewards those who keep their eyes on the finish line. 3. Diversifying your portfolio. Diversification, often likened to the secret sauce of successful investing, is a strategy that holds a prominent place in the toolkit of savvy investors. This approach involves spreading your investments across a range of asset classes, and it's like having a well-balanced recipe that not only minimizes risk, but also enhances your potential for achieving your financial goals. To truly grasp the power of diversification, let's dive into an illustrative example. Imagine you're in the process of building your investment portfolio. Traditionally, you might be inclined to put all your available funds into a single asset class, say, stocks. While stocks have the potential for high returns, they also carry a heightened level of risk due to market volatility. A sudden market downturn or economic turbulence could result in significant losses if you've placed all your bets on one asset class. Now, consider the concept of diversification. Instead of concentrating all your resources into a single basket, you decide to distribute your investments across various asset classes, such as stocks, bonds, and real estate. This strategic diversification doesn't stop at asset classes, it also extends to different sectors of the economy, such as technology, healthcare, and consumer staples. Here's where the magic of diversification becomes evident. Let's take a closer look. 1. Spreading risk. When you diversify your investments, you spread the risk. For instance, while the stock market might experience a downturn, your bond investments might remain stable or even increase in value. The same goes for real estate or investments in other sectors. This means that even if one area of your portfolio isn't performing well, the overall impact on your investments is cushioned. 2. Steady returns. Diversification not only safeguards your investments but also aims to provide more consistent returns. It's about creating a portfolio that can weather the storms and maintain its value over time. This steadiness can be particularly reassuring during volatile market conditions. 3. Cushioning losses. By branching out into different sectors and asset classes, you're less likely to suffer major losses if a particular sector or asset class faces a setback. For instance, let's say the technology sector encounters challenges, but your investments in healthcare and consumer staples remain strong. This mitigates the impact of the technology sector's struggles on your overall portfolio. 4. Alignment with goals. Diversification can be tailored to your specific financial goals and risk tolerance. It's a versatile strategy that allows you to balance risk and reward in a way that aligns with your individual needs and objectives. In conclusion, diversifying your portfolio is like crafting a recipe for success in the world of investing. It's the key ingredient that adds balance, stability, and resilience to your financial journey. By distributing your investments across various asset classes and sectors, you're not putting all your eggs in one basket. This approach helps safeguard your investments against the inherent volatility of the market, and enhances your prospects for achieving your financial goals. So, remember, diversification is your secret sauce for successful investing. 4. Doing your research. In the realm of investing, knowledge is power, and the foundation of that knowledge lies in the art of research. Before you commit your hard-earned money to any investment, it's not just advisable but imperative to delve into the depths of understanding and comprehending the risks involved. This diligence is particularly critical for those who are new to the world of investing. So, let's explore this notion of research and its pivotal role in making informed investment decisions. Imagine you're at a crossroads, considering investing in a specific company's stock. It's an exciting prospect, but it's also rife with uncertainty. This is where the power of research comes into play. Here's a practical tip to guide you on your research journey. 1. Financial news articles. These are your windows into the broader economic and market landscape. Reading financial news articles will keep you informed about market trends, economic indicators, and news that could impact your investments. For instance, you might come across articles discussing a company's recent earnings report or its strategic moves. This information can be a valuable source of insight. 2. Company reports. Dive deeper into the company's specific details. Company reports often provide comprehensive information about the organization's financial health, performance, and future prospects. You can find reports on a company's website or through financial news outlets. These reports can reveal essential data like revenue, profit margins, growth strategies, and even potential risks. 3. Analyst ratings. Analysts dedicate their time to scrutinizing companies and offering their insights. Analyst ratings can provide you with an expert perspective on the company you're considering. It's like having a compass to guide you through the investment landscape. Ratings can range from buy to hold to sell, and they often come with explanations that shed light on the rationale behind the rating. 4. Financial advisor guidance. Sometimes, the investment world can be complex, and it's okay to seek guidance. Financial advisors are professionals with expertise in managing investments. They can help you navigate the complexities of the market, create a personalized investment plan, and make well-informed decisions that align with your financial goals. The act of conducting research serves several vital purposes. Risk mitigation. Research isn't just about seeking potential rewards, it's also about identifying and mitigating risks. For instance, by analyzing a company's financial health and its competitive position in the market, you can gain insights into the risks that may be associated with investing in its stock. Informed decision-making. Research equips you with the information needed to make informed investment decisions. You're not relying on gut feelings or hearsay, instead, you're making choices based on concrete data and expert analysis. Reducing surprises. The last thing you want in the world of investing is an unpleasant surprise. Effective research minimizes the element of surprise by unveiling potential pitfalls and challenges. It helps you anticipate and plan for various scenarios, making you a more prepared and resilient investor. In essence, doing your research is like equipping yourself with the necessary tools and knowledge to navigate the intricate landscape of investments. It empowers you to approach your financial future with confidence, make informed decisions, and ultimately, reduce the element of surprise that can often accompany the world of investing. So, whether you're new to investing or a seasoned pro, never underestimate the power of research. It's the compass that can steer you towards your financial goals. 5. Rebalancing your portfolio regularly. As an investor, one of the certainties in life is change. Over time, your personal circumstances evolve, your financial goals adapt, and market conditions fluctuate. That's where the concept of portfolio rebalancing comes into play. It's not just a good practice, it's a crucial one to ensure your investments remain in sync with your ever-changing needs and aspirations. Let's explore how rebalancing works and why it's so pivotal. Imagine you've been diligently saving and investing for years, and you're getting closer to retirement. Your investment goals are shifting. Now, you're looking for more stability and security in your portfolio to ensure your nest egg is protected during your retirement years. Regular portfolio rebalancing is the tool that allows you to fine-tune your investments to align with these new objectives. Here's how it functions. 1. Asset allocation. When you initially set up your investment portfolio, you defined an asset allocation that suited your risk tolerance and objectives. For example, you may have decided on a mix of 70% stocks and 30% bonds. This allocation was designed to balance risk and potential reward in line with your long-term goals. 2. Changing goals. However, as you approach retirement, your risk tolerance might decrease. You now want to prioritize the preservation of capital and a more stable income stream. This is where rebalancing comes in. 3. Rebalancing action. To realign your investments with your new goals, you may decide to shift your allocation to, for instance, 50% stocks and 50% bonds. To do this, you'd sell some of your stocks and buy bonds to bring your portfolio back into line with your desired asset allocation. Why is this crucial? Here are a few reasons. Risk management. By rebalancing, you're effectively managing risk. As your life circumstances change and your objectives shift, maintaining an appropriate balance between asset classes is essential to control risk. It helps you avoid the overexposure to risk when markets are soaring and excessive caution when markets are turbulent. Alignment with goals. Your investments should always align with your goals. If your goals change, your investments must change with them. Rebalancing ensures that your portfolio remains in sync with your long-term objectives, be it for retirement, buying a home, or funding your child's education. Optimizing returns. Regularly rebalancing your portfolio helps you take advantage of opportunities. For instance, if certain assets have performed exceptionally well, selling some of them and reinvesting in underperforming assets can be a strategy to potentially optimize your returns. Emotional discipline. Rebalancing also enforces discipline in your investment strategy. It prevents you from making impulsive decisions based on market euphoria or panic. Instead, it encourages a methodical and rational approach to managing your investments. In essence, rebalancing your portfolio is like tuning a musical instrument. It ensures that your investments are in harmony with your financial goals, reducing the discord that can arise if left unattended. By adjusting your portfolio regularly, you maintain a balance that's conducive to achieving your objectives and effectively navigate the ever-changing landscape of the financial markets. So, remember, like any well-orchestrated symphony, your investments need regular tuning to stay on track. As we wrap up our discussion on investing in 2024, remember that investing is a journey, not a sprint. By following these guidelines and staying informed about the ever-changing financial landscape, you can increase your chances of long-term success. If you're just starting your investment journey, don't hesitate to reach out to a financial advisor. They can help you develop a personalized investment plan tailored to your unique needs and goals. That's all for today's episode of the Mastery Mindset podcast channel. I hope you found this information valuable and insightful. Before we go, please remember to subscribe to our channel, and if you have any questions or topics you'd like us to cover in future episodes, feel free to leave a comment below. Thank you for joining us, and we look forward to seeing you in the next episode.